Hi everyone, this is Ed Sorrentino. I also go by Zeus Trader, who runs the Discord Titan Day Trading LLC. And for all my newcomers, today we're going to be going over options trading. What is a call, what is a put, and what are the factors that make the premiums on each contract go up and down? Well, first off, what is a call? A call is the right to own a stock at a certain strike price, right? And 100 shares of it. So to own a stock, 100 shares at a certain strike price. So for this contract specifically, we're looking at NKLA calls. We have the right to own NKLA at $15, right? For a premium of 28 cents times 100, total cost of the contract will be $28. Now, what is a put? A put is the right to sell or short a stock at a certain underlying price. So, if we look at the $15 puts for NKLA, the premium is $1.13 or $113, right? And this is the right to short the stock at $15 upon expiration. Okay, well, that's great to know, right? But for me, as an options trader, I don't like to exercise my options. I like to trade the options, right? So, well, okay, this is great information, but how do I trade it? Well, first you have to understand, well, what makes up this premium? Why is this premium? Why is the $15 puts cost $1.13 when the calls cost 28 cents? Well, this is why. Every option, the premium of every contract, right, is made up of two things. It's made up of intrinsic value and extrinsic value. So intrinsic value is the difference between the strike price and your current stock price, right? And extrinsic value is pretty much the difference between the premium and intrinsic value. So another way you can look at it is, what is extrinsic value? It's pretty much the difference between the premium and the intrinsic value. Okay. So that being said, let's go back to our NKLA calls. Okay. So since this stock is at $14.25, these $15 calls are considered out of the money calls. What does that mean? Well, that means that this 28 cents has no intrinsic value. Okay, no intrinsic value. It has all extrinsic value or time decay. Okay, we're going to get into that. Just bear with me. All right. So pretty much upon April 1st, right? These $15 calls, if this stock stays below $15, these calls will be worthless. Why? Because the stock is below $15. So why would someone pay a premium on a contract that is out of the money? Correct? Right? But if you look at the $14 contracts, right, the strike price 14, the current stock price is $14.25, you can see that there is 66 cents on these contracts. The premium is 66 cents or $66. Okay, well, why is this so much more expensive than the $15 call? Well, remember, premium equals intrinsic value minus extrinsic value. And since this contract is below the current stock price, this is considered in the money. So we do have not only extrinsic value, but we also have intrinsic value. So if we take a look back to our little diagram, so you can see over here, remember, intrinsic value is the difference between your current stock price and the strike price, right? So we are looking at the $14 calls for NKLA. The stock price is $14.25. Therefore, your intrinsic value of the 66 cents, your intrinsic value is 25 cents. So, if this stock does not move, okay, upon expiration on April 1st of this week, these 66 cents calls for the strike 14 will only be worth 25 cents if the stock does not move. So let's just say upon expiration on April 1st, that's a Friday, the stock is still $14.25, then the $14 calls will only be worth 25 cents, right? Because That is intrinsic value. That's the real value of the contract, right? No time value. Okay, well, what is extrinsic value then? Well, extrinsic value is pretty much time decay, right? So it's, like I said, the premium minus intrinsic value, or the real underlying stock contract value of the contract, okay? And we like to call this time decay. So now time decay is made up of all these different Greeks that have different factors, okay? So if you click on the option, you can see that they have the Greeks, right? Nice big letters here. Delta, gamma, theta, vega, RHO. What are all these things, right? So I'm going to go over them really briefly, just so everyone gets an idea. Delta. Delta is a measure of the change on an option's price, that is the premium of an option, resulting from a change in the underlying security. Okay, so what this really says, as I'm taking this information from Investopedia.com, is that if this stock moves from $14.25 to $15.25, then these contracts will go up. If the stock moves $1, then these contracts will go up 56 cents. So you take the 56 cents, you add to 66 cents, and that'll be the new value of your contract if we see a 1 point move in the stock, right? Okay, that's great. Now, what is gamma? Gamma is the change, is the change in delta, okay, for every 1 point move that the stock incurs. So yes, if the stock goes from $14.25 to $15.25, then yes, these contracts will go up by 56 cents. But not only will the contracts go up by 56 cents, gamma, right, will also, this 27 cents if we round it, will also be added to delta. So not only will the price of the premiums go up, but so will delta by 26 cents if this 1 point move happens relatively soon. Okay, that's great. So now we cover delta, we cover gamma. Now what is theta? Why is theta negative, right? What is this? Theta is your time decay, right? This is what makes up the bulk of the extrinsic value. It's time decay. So for every 1 day, right, what does this minus negative 7 cents mean? Well, what that means is that for every day for every trading day, okay, that you go along, let's just say you hold the contract, you are going to be losing 7 cents. Yes, that's right. For every day, you're going to be losing 7 cents. 7 cents every day that you hold this contract, no matter what. Okay. So, and yes, delta will change. Okay, so if these contracts go way in the money, let's just say the stock jumps to $18, then there's going to be a lot more intrinsic value than extrinsic value. Understand? That's great. Okay, good. So we covered those 3 very important Greeks. Now we will cover the other 2 now. Alright, so real quick, Vega. Vega is the amount of change that the option will incur per percentage move in implied volatility. So this is important because if everyone's trading a specific option at a specific time, so if implied volatility is 200%, 300%, 400%, that's a lot of Vega. I understand this is only less than half a penny, so only half a penny is affected per percentage change in implied volatility. But when you do get those spikes in options, right, those spikes in options due to a spike in the stock, implied volatility is very important. You do not want to be buying a contract out of the money if you're buying the top of a peak when a stock is rallying, or because you will be screwed. You'll get screwed in time decay. You'll get screwed in Vega. And when I first started trading options, I've experienced some significant losses. Even if the stock hit the same price that I bought it at, the contracts never came back because implied volatility was so high when I bought them. So implied volatility is very important. RHO has to do with interest rates, how the contracts react to per percentage of interest rates that are changed. Interest rates are relatively low these days, so this is not really too important. And as we know, the Fed's not changing them anytime soon, so RHO, not too important. I wouldn't really worry about that right now if you're new to trading contracts. Just worry about what makes up the Greeks, what's a good contract, what's a bad contract, what is a call, what is a put, and be very cautious of your time expiration, because if you expect something to happen over a decent amount of time, then maybe this week's expiration is not the best thing to be purchasing. Maybe a few months out, maybe next year. All those things are factors, but just right now, the basics: delta, gamma, theta, vega. Calls, the right to own a stock at a certain price. Puts, the right to short a stock at a certain price. And like a call option, the puts have the same thing: delta, gamma, theta, vega, RHO. And they do work the same manner. So for a put, if we look at the $14 puts, right, they're trading at 50 cents. These are considered out of the money because we're the right to short a stock at $14.25. So you have to kind of think the opposite when you're looking at puts. And pretty much every time the stock goes down 1 point, so from $14.25 to $13.25, then this contract will go up in price by 44 cents. And after that 1 point move happens, think remember gamma, well, then delta will now be 43 plus 27. So gamma is affecting delta, right? Theta is affecting the overall time decay of the contract, just like the calls. This is losing 7 cents per day. And vega, same thing with the contract. Applied volatility times this by that, and that's how much is made up in the extrinsic value regarding vega. I know this is a lot at first, but just take some time, digest the information, do your own research. This is very helpful stuff, especially for when you're beginning. There's no reason to bet the house right away, and you should never be betting the house at all. But when you're just starting off trading contracts, start small. Start with double-digit stocks, even single-digit stocks, so you're not buying, too expensive contracts. Obviously, this is a $14 stock, so the contracts are not going to be too expensive. But if you look at stocks like Tesla, Apple, Microsoft, any big tech company, contracts can be very expensive. Be careful, be smart, and make sure you know what you're trading before you trade it. Thanks.